Hi friends, welcome to the channel JIV and CIV Made Simple. In this particular lecture, we are going to discuss memory based question of foreign exchange certification course which were asked on 8 February 2025. So let's get started. Hopefully I have got a lot of messages from your side that please prepare another video. So friends, this is another video I am preparing, and this was exactly the same question was asked on 8 February, and I request you to join our Telegram group in the description section where you will find more such memory based topic. And if you want to share memory based topic, you can also put your question on the Telegram group. Those person who will share maximum question, I will give maximum discount on the next certification course. So you can WhatsApp me to me also. Number is provided in the description section after you give the examination. So first of all, let's see what are the questions which have been asked in the previous year. So first of all, try it yourself and then see the explanation. So the question is, if a holiday is declared on day 2 for day 5, how it will be classified? Option A, known holiday. Option B, suddenly declared holiday. Option C, optional holiday. Option D, restricted holiday. So these are the 4 options given. Right, take a moment to think about it. Got your answer? Great. Now let's break it down. Option number A is a known holiday, right? So this option says that it is known holiday. A holiday is considered known if it is declared at least, so this is the keyword, if it is declared at least 3 working day in advance. So this is a very important criteria which you must know. A holiday is considered known holiday if it is declared at least 3 working day in advance. Let's see if this apply here. So here, if the day 2 is a working day, right, and the holiday is for day 5, right? So there are 3 full working day: day 2, day 3, and day 4. Right, day 3, day 2, day 3, and day 4 before the holiday. So there are 3 full working day before the holiday, right? So since it was declared at least 3 working day before, so this indeed qualify as a known holiday. Yes, very good. Option number B says suddenly declared holiday. This option suggests, however, for an holiday to be suddenly declared, it would need to be declared with less than 3 working day. So it would need to be declared with less than 3 working day. You must know it. So since we have 3 full working day here, so this does not fit. So this option is incorrect. Optional holiday. So optional holiday are typically those that employee can choose to observe or not, depending on their personal preference. So this does not apply to our scenario because the question does not mention anything about the holiday being optional. So this option is incorrect. And option D, restricted holiday. Lastly, we have restricted holiday. So these are usually those that are not mandatory for everyone and might have certain restriction or condition. Again, our scenario does not mention any restriction. So these do not apply here. So the correct answer to this question is option number A, right? Known holiday, because it was declared with more than 3 working day notice. And here are some key points to remember. The first point is that known holiday is declared at least 3 working days. This is very important point which you must know. It must be declared at least 3 working days in advance, and always count the working day between the declaration and the holiday to determine if it is known and sudden. If you enjoyed this explanation and found it helpful, don't forget to like, share and subscribe to my channel for more such learning session. Now let's shift our focus to question number 2, and you can see question number 2 on your screen. So this is the explanation part. Question number 2, if a holiday is declared on day 3 for day 4, how will it be classified? Right. So very good question it is. So option number A, known holiday. Option number B, suddenly declared holiday. Option number C, national holiday. Option number D, gazetted holiday. Right. So take a moment to think about it. Got your answer? Great. Now let's break it down. So first option is known holiday. So for an holiday to be considered known, I just told you that it must be declared. It needs to be declared at least 3 working day in advance in our scenario. But in our scenario, what is happening? That if day 3 is a working day, right? So and the holiday is for day 4. So in this case, what is happening? There is only 1 working day notice. So this does not qualify as a known holiday. What about option B, suddenly declared holiday? Yes. So a holiday is considered suddenly declared if it is announced less than 3 working day before. Since there is only 1 working day between the declaration and the holiday, so it was declared on day 3 for day 4. So there is only 1 working day, right? So this fit perfectly. It was not declared with enough advance notice, so it is indeed a suddenly declared holiday. This is the correct answer. National holiday, this is wrong, because national holiday are typically observed across the entire nation and are usually well known in advance. Right. And if we talk about the gazetted holiday, so they are officially declared by the government and are usually published in Gazette. While this might be gazetted holiday, The question is specifically about whether it was declared suddenly or not. So this option does not fit the context. So the correct answer to this question is option number B. So here are some key points to remember is that suddenly declared holiday is announced less than 3 working days in advance, and always count the working day between the declaration and holiday to determine if it is sudden or known, right? So two things are there, either it will be sudden or it will be known. So you must know it. Now let's switch our focus to question number 3. You can see question number 3 on your screen. So friends, so in this question we have this is the MCQ based on how import bill work under LC. So the question is, an import bill under letter of credit is received by the LC opening bank on 1st March as demand bill. So it has been, the main point has been darkened, right, highlighted. When it will be crystallized into rupee liability if 10th March is a Sunday or holiday, right? Option A, 9th March, 10th March, 11th March, 12th March. Take a moment to think about it. So option number A, 9th March. This option says that bill will be crystallized on 9th March. However, the rule is that demand bill are crystallized on the 10th day. What is the rule? That demand bill. So this is the demand bill, and you know, demand bill are crystallized on 10th day, right? It is crystallized on 10th day from where they are received. So this does not fit. Option number B, 10th March. So this option suggests that it is 10th March. While this is technically the 10th day, 10th March is a Sunday, right? You can see 10th March is a Sunday clearly written. So which means it is holiday. According to the rule, if the 10th day fall on holiday, the bill is not crystallized on that day. So this is also wrong. Now let's see option number C. Option number C says 11th March. Remember, if 10th day fall on holiday, the bill is crystallized on the next working day. So since 10th March is Sunday, the next working day is Monday, 11th March. So this fit perfectly with the rule. And 12th March, this is wrong, because you know 11th March is the next working day after the holiday. There is no need to wait till 12th March. So the correct answer to this question is option number C, 10th March, 11th March, right? Because it is the next working day after the holiday. So here are some key points to remember, that you must remember that demand bill are crystallized on the 10th day from where they are received. This is the main thing that you have to remember. Second point is that if the 10th day fall on holiday or Saturday, the bill is crystallized on the next working day. So if you enjoyed this explanation, don't forget to hit the like button. And friends, if you are looking for a study material for foreign exchange, because you know we have added 3 to 4 separate previous year question paper on our course. So there is a course on foreign exchange, right, in which you get unit wise theory PDF, unit wise MCQs PDF, and previous year question, memory based question, which have been collected from the students who have given the examination, right? The course link is provided in the description, or you may WhatsApp me on this particular number is shown on the screen, to get more detail regarding the course, right? Because this course has a huge success ratio, because most of the people who have enrolled in the course, which only cost rupees 200, they have successfully cleared the examination in their very first attempt. So if you are looking for it, you can just WhatsApp me on this particular number. Now let's continue our discussion with our next question, which says that which of the following statement is correct regarding the reimbursement timeline under LC and export to Russia? Very good question it is. Let's answer it. So basically options are: export to Russia if reimbursed by RBI must be settled within 15 days. Option B, if an LC allow reimbursement by electronic means, the claim. So question is which is correct, right? If an LC allow reimbursement by electronic means, the claim must be made within 10 days. Option number C, if LC provide TT reimbursement, the claim must be made within 5 days. Option D, if an LC allow reimbursement after a negotiation period, the claim must be made within 5 days plus additional specified day. Take a moment to think about it. Which option is correct has been asked. Great. I hope you got your answer. Now let's break it down. Option number A, export to Russia settled in 15 days. So what do you think? So however, it says that this option says that export to Russia reimbursed by RBI must be settled within 15 days. However, the actual rule is that such reimbursement must be settled within 20 days, not 15 days. Right? So this is wrong. Then option number B suggests that if an LC allow reimbursement by electronic mean, the claim must be made within 10 days. Right? So, but this is incorrect, because reimbursement through TT. What is the meaning of TT? Telegraphic transfer. Reimbursement through TT or similar method must be claimed within 5 days. You must remember it must be claimed within 5 days, not 10 days. Option number C says that TT reimbursement in 5 days. So this option says that TT reimbursement under an LC, letter of credit, must be claimed within 5 days. See, it is written. But while this is correct for TT reimbursement, specifically it does not cover all scenario, like those involving negotiation period. There are some scenario which involve negotiation period, right? So those scenario which involve negotiation period, in that case it does not fit well. So while partially correct, it is not the most complete answer, right? So again I am repeating, this option number C suggests that TT reimbursement under LC must be claimed within 5 days. This is correct for TT reimbursement. It does not cover all scenario like those involving negotiation period. And option number D says that if LC allow reimbursement after a negotiation period, the claim must be made within 5 days plus additional specified day. This is correct because when a negotiation period is involved, so here the key point is negotiation period. Whenever the negotiation period is involved, those extra specified day to the standard 5-day timeline for making a claims, right? So there are some 5 day plus additional specified day. This is the key point, right? So this make option D the most accurate and comprehensive answer. So the correct answer is option number D. So what we learned from this question, let me summarize the fact a little bit. So our learning is that so this is the explanation part. So our learning is that reimbursement for export to Russia via RBI must follow a timeline of 20 days, right? This is the first point. Second point is that reimbursement claim via TT or electronic mean must be generally be made within 5 days. And the third option is that if there is a negotiation period in an LC, letter of credit, you add those extra specified day to the 5-day timeline, right? So remember these 3 points, super important, right? Now let's switch our focus to our next question. The next question you can see on your screen. It says that so friends, this question is about interbank Vostro transfer via RTGS and the submission of Form A3. Which of the following statement is correct regarding interbank Vostro transfer via RTGS and Form A3 submission? Option number A, the remitting bank must mention in RTGS message, we undertake to send Form A3 separately. Option number B, the beneficiary bank must receive Form A3 within 10 working days or a penalty is imposed. Option number C, if the beneficiary bank does not receive Form A3 within 5 working days, it must lodge a claim within 15 days from the date of fund transfer. Option number D, the remitting bank must ensure Form A3 reaches the beneficiary bank within 30 days of the transfer. These are the 4 options. So, so friends, the 4 options have been given. Take a moment to think about it. Right, take a moment to think about this question. Got your answer? Let's break it down. Option number A suggests that sorry friends. So option number A suggests that it says that remitting bank must include a remark in RTGS message, we undertake to send Form A3 separately. This is actually correct. As per FEDI rule, FEDI, Foreign Exchange Dealer Association of India, as per FEDI rule, right, this rule is correct, but it is not the most comprehensive answer because it does not address timeline or penalty, right? That's why this is not the comprehensive answer. Option number B, right, it states that Form A3 must reach the beneficiary bank within 10 working days or a penalty is imposed. This is incorrect because the actual rule is that Form A3 must be submitted within 5 working days, not 10 working days, right? So this is wrong. Now let's see option number C. So question is which is correct, right? Which is correct. Now option number C says that this is also it says that if the beneficiary bank does not receive the Form A3 within 5 working days, it must lodge a claim within the remitting bank within 15 days from the date of fund transfer. That is what it is saying. This is absolutely correct. It covers both the 5-day submission deadline and what happens if there is a delay. Very important. So you can see 5-day submission deadline is there, right, for Form A3, and also it must lodge a claim within 15 days from the date of fund transfer. 2 things have been covered here. This is the correct answer. And option D says that the remitting bank has 30 days to send Form A3. This is incorrect because no such 30-day rule exists for the Form A3 submission. So the correct answer to this question is option number C. So here are some key points to remember. You must remember is that the remitting bank, right, must include a remark in RTGS. It must include a remark in RTGS message about sending Form A3 separately. Form A3 must reach the beneficiary bank within 5 working days or penalty will apply. And if there is a delay, the beneficiary bank has 15 days from the transfer date to lodge a claim. So see what is happening here. There are 2 banks are there. One is remitting bank, other is the beneficiary bank. Someone is receiving, someone is giving. That's it, right? So the remitting bank must send a message that we undertake to send Form A3 separately, right? And beneficiary bank must receive Form A3 within 5 working days or a penalty is imposed. and if it does not receive Form A3 within 5 working day, it must lodge a claim within 15 working day. So these are the timeline which you must, and question on timeline are very frequently asked in examination. You must note it down. Now this is a very good question. The next question we have, as you can see on your screen. So it is related to, which of the following is not a permissible capital account transaction, right, by an individual under LRS. LRS, it's called liberalized remittance scheme. So which is not a permissible. So please read it carefully. Not a permissible. Most of the time we ignore this word, right? So let's see the option number A: opening a foreign currency account abroad with a bank, acquiring immovable property abroad, making ODI, that is overseas direct investment, and OPI, that is overseas portfolio investment. And option number D suggests that giving loan in Indian rupees to any non-resident India, that is NRI. So these are the 4 options. Take a moment to think about it. Got your answer? Let's break it down. So option number A, opening a foreign currency account with, so this option states that this option is correct under LRS, opening a foreign account abroad with a bank, because individuals are allowed to open and maintain foreign currency account with bank abroad for various transactions like investment or property purchase. Option number B suggests acquiring immovable property abroad. This option is also correct because LRS permit individual to invest in overseas business or financial asset like share and mutual fund. Option number C, making overseas direct investment and OPI. So this is where the rule get specific. This option is also correct. LRS permit individual to invest in overseas business or financial asset like shares and mutual fund. And option number D, giving loan Indian rupees to any NRI. Yes, this is where the rule gets specific. Loan can only be extended to NRI who are relative. So only those NRI who are relative, only to them loan can be extended, right, as defined under the Companies Act. So relative must be defined under the Companies Act, and those relative only loan can be extended. Giving loan to any NRI who is not relative is not allowed under LRS, making this the correct answer for what is not permissible, right? So the correct answer is option number D, right, but this is not permissible. So let's summarize. There are some key points which you must keep in mind. Some question can be asked regarding not a capital account transaction. So LRS allow capital account transaction like opening foreign currency account, buying property, making investment abroad. Loan under LRS can only be given to NRI who are relative as per the Companies Act. Always check a specific condition before making transaction under LRS. So this was the explanation. I hope this makes sense to you. This is quite clear to you. Don't forget to hit the like button so that most other aspirant also get help of such kind of videos. Now let us switch our focus and let's see the next question that we have. Here is the question you have. Which of the following statement about ODI? What is ODI? Overseas direct investment is correct. Which statement regarding ODI is correct? Option number A, ODI and FDI are same since both involve cross-border investment. Option number B, ODI occur when a resident company invests in WOS. WOS, wholly owned subsidiary or joint venture in a foreign country. Option number C, country with high ODI usually have weaker economy and less investment competitiveness. Option number D, emerging market receive less ODI due to slower growth rate. So take a moment to think about it. Got your answer? Let's break it down. Option number A suggests that ODI and FDI are same. What do you think? So this is because both involve cross-border investment. However, this is incorrect. Which is correct is I asked. Because FDI refers to when a foreign company invests in other country, right? So suppose when a foreign company, suppose Microsoft. So Microsoft invest in India, right? So this is a kind of FDI, foreign direct investment. But what is ODI? ODI is when a resident entity like an Indian company, for example Infosys, right? When a resident company, right? So whenever ODI, okay, so what is ODI? ODI happen when a resident company, right, invest abroad. Like suppose Infosys is investing in US. So this is called ODI, right? This is called ODI. Right. So there are two different directions of investment. They are not same. Now option number B, ODI occur when resident company invests in wholly owned subsidiary or joint venture in the foreign country. This option states that ODI occur when a resident company invests in WS or JV in foreign country. This is correct because ODI allow, right, companies to expand their operation by setting up or investing in business abroad. Option number C, country with high ODI usually have weaker economy and less investment competitiveness. Right, this option claims that country with high ODI have weaker economy. This is incorrect. A high level of ODI usually indicate a strong and competitive economy because it shows the company has the resources and confidence to invest abroad. This is wrong. Option number D, emerging market receive less ODI due to slower growth rate. So what do you think? Is it correct? This is wrong. This is also incorrect, because emerging market often attract more ODI because they offer rapid growth opportunity. If the market is emerging, right, so they offer rapid growth opportunity, right, they offer rapid growth opportunity, making them attractive for investment. So the correct answer to this question is option number B. So here are some key points to remember. The first point is that ODI involve a resident entity investing in a foreign company, unlike FDI, which is the reverse, right. High ODI level typically indicates a strong economy with competitive business. Emerging market often attract more ODI due to their growth potential. So I hope this makes sense to you. I hope the difference is quite clear. What is ODI? What is FDI? What is the difference? Now let us see one more question related to ODI. Very good question it is. Let's answer it. Question is, which of the following statement regarding ODI is correct? Okay. Option number A, under automatic route, Indian company require prior approval for all overseas investment. Option B, if an Indian company does not meet the condition of automatic route, it must seek RBI approval under the approval route. Option number C, resident individual can invest in joint venture or wholly owned subsidiary abroad, but only up to $5 lakh per financial year under the LRS. And let's see option number D. Question which is correct have been asked. Option number D, resident individual investing under LRS can write off their investment income if they fail to repatriate it within 60 days. So let's go through each and every option. First of all, you think yourself what is the correct answer. So this option is suggests that Indian company need prior RBI approval for all investment under the automatic route. This is incorrect, because under the automatic route, company don't need prior RBI approval as long as they meet certain condition, such as, what is the condition, such as for staying within the 400% of their net worth. If they stay within the 400% of their net worth, they do not require any permission from RBI or RBI approval. So this option is wrong. Option number B suggests that if the Indian company does not meet the condition of automatic route, it must apply under approval route. This is correct. Under automatic route, proposals are scrutinized by the authorized dealer bank and forwarded to RBI for approval. So see, this ODI company, first of all, they send their application to AD, and then further this AD scrutinize the application form and then send it further to RBI, right? So this make option B the right answer. If it is, so see, obviously if the condition does not meet for the automatic route, so they will apply under approval route. There are two kind of routes are there. Option number C claims that resident individual can invest up to $5 lakh per financial year under LRS. This is completely incorrect, because the maximum limit is $2,50,000 under LRS. That's it per financial year. Okay, and let's go through the option number D. Option number D, what it suggests? It says that option D claims that resident individual can write off their investment income if they fail to repatriate it within 60 days. This is false, because FEMA guideline require individual to repatriate income earned from investment within 60 days, and not this, not within 60 days, and not no write off is allowed. Write off cannot be done, right? Cannot write off. So this write off word is wrong, and they can, if they fail to repatriate, right? So FEMA guideline requires individual to repatriate income earned from investment within 60 days. So the correct answer is option number B. So what we learned, say, here are some key points which you must keep in mind, right? First thing is that the automatic route, right? The automatic route allow ODI without prior RBI approval if the condition like staying within 400% of their net worth are met. And the approval route applies when the conditions are not met or for restricted sector like real estate or banking. Under LRS, resident individual can invest up to $2,50,000 per financial year. I hope this makes sense to you. Now let's see one more question, that which of the following is not allowed under LRS, but which is prohibited under LRS. This question is most frequently asked. What are things prohibited under LRS? So option number A suggests, right, that remittance for purchasing FCCB. You know what is FCCB? Foreign currency convertible bond issued by Indian company in the overseas secondary market. Option number B, remittance for personal travel, medical treatment, education abroad. Option number C, sending money abroad for margin call on overseas exchange. Option number D, remitting fund to a country identified as FATF. You know FATF? Recognized as non-cooperative jurisdiction by FATF, that is Financial Action Task Force. So what do you think? What do you think is the correct answer here? So friends, let's take a moment to think about it. So option number A suggests purchasing an FCCB, right? Which is foreign currency convertible bond. This option is correct, because purchasing this FCCB, purchasing FCCB issued by Indian company in overseas secondary market is not allowed under LRS. So question is, which is not allowed under LRS? Yes, this is correct. It's not allowed under LRS, right? It is one of the specific restrictions mentioned in the RBI guideline. Option number B, personal travel, medical treatment, education abroad. So this option is incorrect because LRS allow remittance for personal travel, medical treatment and education abroad. So that's why this option is incorrect. Option number C, sending money for margin call or overseas exchange. This option is correct because sending money abroad for margin trading or margin call or overseas exchange is prohibited under LRS. Is prohibited under LRS, right? So this is correct. And option number D, remitting fund to a country identified as non-cooperative jurisdiction. So this option is also correct because LRS prohibits remittance to country identified as non-cooperative jurisdiction. Right. So these countries are flagged due to financial risk like money laundering or terrorism financing. So the correct answer to this question is option number A. Right. So what we learned from this question is that LRS allow remittance for personal purpose like travel, education, medical treatment. Some prohibited transactions include purchasing FCCV in foreign market, margin trading on overseas exchange, remittance to FATF, non-cooperative jurisdiction. So we must always check RBI guideline before making international remittance. That's the point. Now let's see the next question. Which of the following, just wait a minute. So which of the following statement about DDA is correct? DDA, diamond dollar account. That is the point. So option number A suggests that DDA is a saving account for exporter in the gems and jewelry sector, earning interest on deposit. Option B suggests only firm engaged in gold trading can open a DDA. Option C suggests that DDA is a current account in US dollar meant for gems and jewelry export with no interest paid. And option D suggests that firm without any prior export import experience in diamond or jewelry can open a DDA immediately. What do you think? What is correct about DDA? So let's go through option by option. Option A suggests that, first of all, talk about option number A. Option number A suggests that DDA is a saving account. So where exporter earn interest on deposit. This is incorrect because DDR is strictly current account. This DDA is not a saving account. DDR is strictly the current account, right? And no interest is paid on balance held in this account. You know it very well. Only firm engaged in gold trading can open a DDA. This is incorrect because DDR is specifically for firm dealing in rough cut or polished diamond. Because name itself suggests diamond dollar account. So either it is rough, either it is cut, or either it is polished diamond, right? Option C says that DDA is a current account in US dollar with no interest paid. This is correct because DDA is a non-interest bearing current account maintained in dollar. Because that's why in the name you will see dollar account. So it is maintained in US dollar, right? Created for exporter in the gems and jewelry sector. It allows them to transact directly in dollar without converting fund into Indian rupees. Option number D, firm without any prior export import experience in diamond can open. This is wrong. They require 2 years of good track record. 2 years of good track record, right? Because no firm with no experience cannot open, right? Because firm must have at least 2 years, at least 2 years of good track record in exporting and importing diamond or jewelry. Then only they can open this DDA account. You must remember this condition, right? So let's summarize once more. So let's summarize the point which we have learned in this question. The first point is that that DDA is a current account in US dollar. First point, that it is a non-interest bearing current account in US dollar. You can see non-interest bearing current account in US dollar. It is available to exporter dealing in diamond and precious metal jewelry who meet eligibility criteria like having at least 2 years of export import experience. And DDA help exporter avoid currency conversion cost by allowing direct dollar transaction. So currency conversion cost get reduced. That is the main advantage of DDA. So now let's see the next question. Which of the following statements regarding the purchase or sale of immovable property in India by foreign entity is correct? Right. So let's go through the option. Option number A, foreign embassies and diplomat can buy immovable property in India without any government clearance. Option number B says that citizens of Pakistan, Bangladesh, Sri Lanka, Afghanistan, China, Iran, Nepal can freely purchase immovable property in India. Option number C, foreign embassy, diplomats and consultancies may or must obtain clearance from Ministry of External Affairs before buying, selling property in India. And OCI, overseas citizen of India, are also restricted from purchasing immovable property in India. So this question were exactly as it is asked in the examination. So let us answer this particular question. So which is the correct one? So friends, option number A is incorrect, because foreign embassy, diplomat and consultant cannot freely buy or sell property in India. They must get clearance from the MEA. So this is incorrect. Option number B, this option is also incorrect, because citizens of this country like Pakistan, Bangladesh, Sri Lanka, Afghanistan, China, right, they cannot acquire or transfer immovable property in India without prior approval from RBI. They must take prior approval from RBI, right? So here the key point is that RBI approval is very much required. The third option is, I think it is correct, because they must get clearance from MEA, that is Ministry of External Affairs, right, before buying property. That is the point. And option number D is that OCI are also restricted from purchasing immovable property in India. So this option is incorrect, because OCI are allowed to purchase immovable property in India except for agricultural land. So you must know some exception, that except for agricultural land, they can't buy agricultural land, right? Or we can say plantation property. So suppose some plantation property is there, also they can't buy that, or farmhouse. So these are the three restrictions for OCI. But rest thing they can buy, rest immovable property they can buy, right? But they can't buy agricultural land, they can't buy plantation farm, or they also can't buy this farmhouse. So these three are the main important restrictions which you must keep in mind. Now let's see our next point. The next question is, which of the following regarding NRI loan scheme for purchasing share under ESOP scheme is correct? Correct, remember it, correct is asked. Option number A says that the maximum loan amount that can be availed is 50 lakh. Option number B, the employee must have a demat account to be eligible for the loan. Partially paid share are eligible for finance under this scheme. And option number D, that the loan tenure is 60 months and repayment is through a lump sum at the end of tenure. So which of the following statement regarding NRI loan scheme for purchasing share under the ESOP is correct? This is the question, right? So let's go through each and every option. Option number A, maximum loan amount that can be availed is 50 lakh. This is incorrect, because the maximum loan amount allowed under the scheme is rupees 20 lakh, right? And or we can say either 20 lakh or 90% of the purchase price of the share. So either you say it 20 lakh or you say it 90% of the, let me write it down, 90% of the purchase price of share, 90% of the purchase price of share, either of them, right? Either 20 lakh or 90% of the purchase price of the share. So this option is incorrect. Option number B says that demat account is mandatory for eligibility. So this option is correct. To participate in ESOP, that is employee stock option purchase, so this and avail, so to participate in an ESOP and avail of loan, NRI must have a valid NRI demat account, right? So this is correct. Option number C, partially paid up share are eligible for finance under this scheme. This option is incorrect, because only fully paid share, not partially, only fully paid share, right? Only fully paid share are eligible for financing under the ESOP loan scheme. And what about option number D? What does option number D suggest? That loan tenure is 60 months. So this is also incorrect, because the actual loan tenure under the scheme is 36 months, not 60 months, right? 36 months, right? And and repayment must be made in EMI. EMI, that is equated monthly installment, not as a lump sum. So what are the important points to remember? Let me summarize the fact. So the important point to remember is that the maximum loan amount for NRI under ESOP loan is either 20 lakh, right, or 90% of the purchase price, whichever is lower. So either you call it 20 lakh or 90% of purchase price of share, whichever is lower, right? A valid NRI demat account is mandatory for participating in ESOP and availing loan. Only full paid share, right, are eligible for financing under this scheme. And the loan tenure is 35 months with repayment in EMI. You must remember this point, very very important for participating in ESOP. Now let's move to the next question. The next question is, friends, if this video have been helpful till now, please hit the like button. This will motivate me to make more such and such content, right? So let's see the next question that we have. The question says that a person bringing foreign currency into India is required to submit a CDR, that is currency declaration form, at the airport if, right? Option number A, that if the total foreign exchange exceed USD 10,000 or its equivalent. Option number B, the cash portion exceed 5,000 or equivalent. Option number C, both A and B, right? And option number D, it says that no declaration is required regardless of the amount. Option number A is partially correct, because this is suppose India, right? If you are bringing money, whether it is in the form of cash, whether in the form of traveler check, or whether it is in the form of bank draft, so if it exceed USD 10,000, if it exceed USD 10,000 or its equivalent, you must declare it in the currency declaration form. So this option is partially correct, right? So option number B, let's see option number B. It says that US cash portion exceed 5,000. Yes, this option is also partially correct. If the cash portion alone, which foreign currency notes, if the cash portion or foreign currency note alone exceeds $5,000, so you need to declare it. Option number C satisfies both the condition, and it is the correct answer. You must submit a currency declaration form if either of these conditions is met. The total foreign exchange exceed $10,000 or cash portion exceed $5,000. This ensures transparency and compliance with the RBI regulation. Option number D is wrong. It says no declaration is required. No, this is incorrect. So what is the key points which you must keep in mind? That if the total foreign exchange exceed $10,000 or its equivalent, you must declare it. And if the cash portion alone exceed $5,000 or its equivalent, you must declare it. And always submit a currency declaration form if either of these limit is breached, right? Now, which of the following statement describe the state bill of lading? This is the question regarding state bill of lading. Sorry, not landing, state bill of lading. So let's go through each and every option. Option number A suggests that it is a negotiable document that allow the transfer of ownership of goods during transit. Option number B, it requires the carrier to deliver goods only to a specific named consignee. Option number C, it permits the consignee to endorse the document to another party. Option number D, it is primarily used when goods are shipped without prior payment by the buyer. So option number A, it says that negotiable document. So we are talking about a straight, let me write down, a straight bill of lading, right? So this option is incorrect, because state bill of lading is a non-negotiable document. It's not a negotiable, it is a non-negotiable document. It does not allow the transfer of ownership during transit. You cannot transfer the ownership. Negotiable bill of lading, like those used in letter of credit transactions, serve this purpose, right? So option number A is incorrect, because the state bill of lading is a non-negotiable document. Option number B says that it is required carrier to deliver only goods only to a specific name consignee. Yes, this is correct, because the state bill of lading, it specify that a carrier must be delivered the goods to a particular named consignee, right? So this ensures that only the intended recipient can receive the goods. Option number C, it says endorsement to transfer ownership. So what do you think? This is incorrect, because as I told you, it is a non-negotiable document. It is a non-negotiable. It cannot be negotiated, right? It cannot be endorsed. So since it is non-negotiable document, can you think it can be endorsed? No way. So a state bill of lading does not allow the consignee to endorse it to other party to transfer ownership. Now option number D, it is primarily used when goods are shipped without prior payment by the buyer. This option is also incorrect, because the state bill of lading are typically used when payment have been made in advance, not when goods are shipped without prior payment. This is more common in scenario where payment terms are secured, right? So correct answer to this question is option number B. So you must remember some key points related to the state bill of lading. So let me summarize it for you. So here you can see, let me show you. So these are the points. The first point, you must remember that a state bill of lading is a non-negotiable, right? It means that it does not allow ownership transfer during the transit. Second point, it specifies delivery to a named consignee, ensuring goods are delivered only to the person or entity, and it is used when payment has been made in advance, providing a secure transaction. So these three key points which you must remember regarding a state bill of lading. Friends, we have some more questions available. If you want me to discuss that also, please write yes in the comment section. If this video was usually helpful to you, please write helpful in the comment section. यदि आप चाहते हैं कि आपको मैं बाकी क्वेश्चन भी बताऊं, क्योंकि हमारे पास और भी क्वेश्चन अवेलेबल है, तो आप यस लिखें कमेंट सेक्शन में. और फ्रेंड्स, यदि आपको इससे रिलेटेड कोई कोर्स चाहिए, if you want any kind of course related to the foreign exchange certification course, please WhatsApp me on this particular number. और जो भी, and if any person share the question asked on the 8th March examination to us, I will provide you maximum discount on the next certification course. Okay, so you can provide the question, memory based question on this particular number, right? So for 8th March examination. So that's all for today. Hopefully this video was useful. Thank you.